Welcome to the first episode of the MacroViews Valuation Snapshot. I'll try to do one of these every week, but no promises yet. I'll be releasing a video on my valuation framework in time to come to explain my thought process behind how I roughly value equities. So with that being said, I'm your host Daniel, and let's take a look at Tesla today. After losing about 60% of its market value in the February to March sell-off, Tesla shares proceeded to more than triple in value. From the chart, we can see that Tesla essentially broke into a new paradigm after it broke the 800 handle. Now, before I explain why I think that Tesla is not overvalued yet, take note that I am taking clues from historical trading patterns that may or may not repeat themselves. Also, ignore the implied weighted average cost of capital figure for my models because profit growth is throwing the metric out of whack. So let's turn back time to 2013. Tesla was pretty much trading sideways for the years leading up to the end of 2013. Profitability-wise, Tesla was losing money, averaging about negative 5% ROIC, or return on invested capital, for the whole period. Q ratio was subsequently either range-bound or in decline. Then in 2013, Tesla skyrocketed. Its shares quintupled in value, reaching about $250 per share. This was caused by 4 consecutive quarters of improving ROIC, with Tesla achieving a peak of 6.2% return on invested capital in early 2014. Its Q ratio subsequently surged to a high of 13.65. Since then, Tesla has more or less traded sideways in a very large range. The market also continuously bid lower and lower for its invested capital, as you can see from the declining Q ratio. Then in late 2018, profitability started improving again, going from about negative 1% in late 2018 to about 5% in late 2019. Now this change fell relatively under the radar until the market caught up with this fact in late 2019 when its share surged about 250%. Fast forward to today, after the sell-off in early 2020 and the subsequent rebound, Tesla still stands at its highest profitability at about 5.2%. Not great, but one of the best on its own record. On the valuation side, we can see that the Q ratio has successfully retested the historical resistance of 2.5 in early April. And then it punched through the recent Q ratio resistance of 5, which was set in early February. So currently the Q ratio is at about 8.4. So if we compare Tesla's profitability now and in the past, the market had bid Tesla's Q ratio up to 13.65 in April 2014 when its ROIC was 6.2%. The way that Tesla Q ratio is moving now looks very similar to the trading patterns set in 2013 to 2014. So if we get a similar market behavior as in 2014, there is little reason for Tesla to not retest its Q ratio high of 13.65. Now, I'm not saying that Tesla is cheap. It's very expensive. But whether it is a bubble or not, the trend is probably going to persist for a period longer than most would expect. So you don't want to be fighting this trend. Take a look at this infographic detailing the holdings of Elon Musk. Majority of his companies are riding on strong macro tailwinds, some of which have yet to go into full force. If you haven't heard of the Genesis Institute, I recommend that you read our summary of the strongest macro trends for this decade. I'll put the link in the description below. After reading it, you might see why Elon Musk companies have so much potential. Now, you may be wondering, these companies are not all owned by Tesla, so why should we care? Well, to be frank, I can't really give you a good answer right now, but there is a possibility that what Tesla did with SolarCity may be done with the rest of its companies. It is possible that this outcome is slowly being priced into Tesla shares with increasing probability. Right, now that I've laid out my case for why I think Tesla is not at its top yet, what is the estimated target price for Tesla? To model a possible path for its shares, I will make a few assumptions. First, no change in excess cash, no change in shares outstanding. And since Tesla's return on invested capital started improving in June 2018, invested capital compounded at a quarterly growth rate of about 5.58%. So I will assume that Tesla's invested capital will continue to grow at the same rate. And finally, I'll also assume that Tesla's Q ratio trajectory from 31st of March 2020 will follow the same trajectory that it took in 31st of March 2013. That was when its shares started surging. Obviously, all of these assumptions will definitely not hold true throughout the period, but they should bring us somewhat close to the truth. After modeling the trajectory of Tesla's price, this is what we get. Now, the black line denotes the day that this chart was made, which was Saturday, yesterday. And so the model is suggesting that Tesla will hit about 2030 by the end of September 2020, and then it will top out soon after that. On this chart, I mark out the model suggested target prices at the end of each fiscal quarter. And these target prices, again, they're calculated by extrapolating historical trading patterns. Beware that most bubbles form from the unrealistic extrapolation of past trends. Now, Tesla is definitely trading in a bubble, but let's be frank, with the Feds, whatever it takes, everything is in a bubbly territory where the markets are pricing in asset price inflation. All I can say is don't fight the trend. The trend is your friend. With that being said, I'm your host Daniel, and this has been the Valuation Snapshot for Tesla Inc.